If oil hits $150 per barrel, your money will fill it, even if you never fill a gas tank. If you want to understand how global events quietly impact your wallet, make sure you subscribe because this is where geopolitics meets personal finance. Let's talk about what $150 oil actually means. Oil is not just fuel for cars, it powers transportation, airlines, shipping, agriculture, plastics, manufacturing, electricity. In some regions, oil is the bloodstream of the global economy. When oil resized from $80 to $150, that's not just a $70 increase, it's nearly a 90% jump in energy cost. And energy cost feeds into everything. Now, here's the first shockwave. Gas prices spike. Depending on country, gasoline could rise by 30 to 60%. Diesel rises, trucking costs rise. And when transportation rises, supply chains get expensive. Groceries cost more. Online deliveries cost more. Building materials cost more. Even your Amazon order costs more to ship. But here's where it gets deeper. Businesses don't absorb these costs. They pass them to consumers. That means higher prices across the board. And when prices rise broadly, we call it inflation. Oil is one of the fastest inflation transmitters in the world. Historically, major oil spikes have preceded inflation waves and recessions. 1973. Oil crisis, 2008 oil spike before financial crash. Energy shocks ripple fast and wide. But here's the second layer. Higher inflation pressures. Central banks. If oil hits $150 and inflation rises again, interest rates may stay higher for longer. That means higher mortgage rates, higher credit card rates, higher auto loan rates, slower real estate growth. Your borrowing power shrinks, your monthly payments increase, your disposable income falls. This is how a barrel of oil changes your financial life, and it happens quietly within months. Now let's talk about your investments. When oil surges to $150, markets react immediately. Energy stocks often rise. Oil producers benefit from higher margins, but airlines suffer. Transportation stocks suffer. Manufacturing companies see costs rise. Consumer spending may slow. Retail stocks weaken. Markets begin pricing in slower growth, and when growth expectations fall, broader stock indexes can decline. Now here's where volatility enters. Oil shocks increase uncertainty. Uncertainty increases market swings. Short-term traders love volatility. Long-term investors feel stress. If oil stays elevated for months, recession probability increases. High energy costs act like a tax on businesses. And consumers. Companies see margins shrink. Consumers spend less on discretionary items. Corporate earnings forecasts get revised downward. Stock markets don't wait for recession, they price it in early. Now, let's talk safe havens. When oil spikes sharply, gold often rises. US dollar may strengthen. Treasury bonds may rally. Investors move money into perceived safety. But that also means capital flows out of risk assets. Emerging markets suffer heavily. Oil importing nations struggle with trade deficits. Currencies weaken. Inflation rises further. This creates global financial pressure. So if oil hits $150, your portfolio might not move uniformly. Some sectors win. Many struggle. Volatility becomes the new normal. Now zoom out. If oil stays at $150 for an extended period, global GDP growth slows. Why? Because energy is a core input cost. Developing countries suffer more. Fuel imports strain budgets. Subsidies increase. Government debt rises. Political instability. Risk grows. Meanwhile, oil exporting nations gain leverage. Petrodollar flows increase. Geopolitical influence shifts. This isn't just economics, it's power dynamics. Now consider supply chains. Manufacturers dependent on energy-intensive processes see production costs soar. Transportation-dependent industries shrink margins. Shipping container costs rise. Food production becomes more expensive. Because fertilizer and machinery depend on oil, food inflation becomes more severe. Lower-income households suffer disproportionately. Energy, inflation, is regressive. The poor feel it first and hardest. If inflation surges again, central banks face a dilemma. Raise rates and slow the economy further. Or tolerate inflation and weaken purchasing power. Either path hurts growth. This is why sustained oil spikes historically correlate with economic slowdowns. The global economy runs on affordable energy. Remove affordability, and growth weakens. Now here's the practical part. You can't control oil prices, but you can position yourself. First, reduce variable expenses. High oil means higher everyday costs. Strengthen emergency savings. Second, review energy exposure in investments. Stocks may benefit short-term. diversification becomes critical. Third, watch interest rates. If inflation re-essays again, refinancing windows may close, debt becomes more expensive. Fourth, consider inflation hedges. Commodities, energy exposure, real assets. But avoid panic moves. Markets overreact. Oil spikes can reverse if supply increases or tensions ease. The key is not prediction, it's preparation. Because if oil hits $150, it's not just a headline, it's a chain reaction. From geopolitics to oil markets. 2. Inflation. 2. Central banks. 2. Your mortgage. To your grocery bill. To your portfolio. And that is how one commodity controls global money flow.